Hello and welcome to the stock specific class here for Thursday, April the 7th. If you have any questions during the week or any that I don't get to during the class, make sure you send those to jerry@traderspro.com. Well, on Tuesday, what we were talking about was the the high probability we're going to drop. We did get a drop. What I want to take a look at today is some possible things that could happen now. We had a kind of a gap down yesterday, which kind of complicates things as far as reading the near term. What could happen in the near term? I'll explain that when we're looking at the chart. But to start off with, as far as the direction alerts, these aren't showing us anything extreme. The momentum is right in the middle here. Breadth is right in the middle. Sentiment is still relatively high, but it's moved back. It moved from extreme back into the high area there. With the selling, we did get a little bit of fear coming into the market. We'll look at the VIX here in just a second. You can kind of see that. And I would expect that's going to spike up even higher sometime in the next week or so. Now, the buy-sell ratios, we've started to see a little bit more sells than buys, as you would expect if the market's pulling back. Looks like they're crossing over right here. And we're seeing the buy-sell ratios of the entire market now moving below 1. Now, why is that important? Now, this is not going to be a straight line, but typically when you're going through the process that we go through in the stock specific class, you're looking for high strength ranked sectors or leading sectors and then high strength ranked stocks within those sectors. That process works a lot better and gets more consistent results when the buy-sell ratios of the entire market is above 1. It just makes sense. You want to make sure there's buying momentum going on. You can always find trades, and I talk about this all the time. I can find a trade every day. But if you want to say, is it a high probability trade? What's a high probability trade? Well, a high probability trade to me is when the market looks like it's going to move up and the stock you're looking at looks like it's going to move up. You've got the stock looking like it's going to move in the same direction as the market. That's a high probability trade. What's a low probability trade? Well, a good example of a low probability trade is the market right now looks like it wants to go lower. It looks bearish. And you've got a stock like Costco breaking out. You've got a lot of healthcare stocks, United Healthcare breaking out to new highs. They're up today. Now, again, those were bullish patterns, but with the market conditions more bearish, those are lower probability trades. There's a lower chance that those stocks were going to go up in this type of environment. Now, obviously, in hindsight, we say, well, they did, but again, of course they can. They're in uptrends. I'm not saying they can't go up. It's just that would be an example of a lower probability trade. You don't have the stock matching up with the perceived direction of the market. So that's kind of the process you want to follow. And when you've got a situation where there's not many stocks reaching new buys, in fact, it's going the opposite direction. More are going to sells than buys. You don't want to be buying heavily in that environment because the momentum isn't in your favor. So that's one of the things you just want to keep in mind. Now, it doesn't mean you can't add something here or there. You just don't want to be loading up in those type of conditions. And I talk about that all the time, where there's a difference between finding a stock you want to get into and then finding 10 you want to get into. When's an environment where you want to find 10 you want to get into? Well, it's usually when you've got the market looking like it wants to go higher. All right, so, and then sentiment's backed off from that extreme. Again, none of these are showing any sort of extreme that would cause any concern, and they're not oversold, so there's potential for more downside as well if things start to continue lower. Now let's bring in our charts. Now, again, the point of having these classes, and sometimes it seems very repetitive, but it's to really point out these clues that happen. These, if you can learn to recognize the clues, at times, not all the time, but there are times where you feel like you can predict the move. I was saying there's a really strong probability we're going to drop. I said that on Tuesday, based on what was happening. There's a lot of things lining up for that. And when it does, again, you feel like, oh man, that I was able to predict what happened next. Well, first of all, that doesn't happen very often where you get the really strong clues all lining up. But if you can learn to recognize those, you can take advantage of that. And what I always tell people is you can never know exactly what the market's going to do. And even as high a probability it was that we were going to drop, there's always an outside chance that could get reversed. Some news could break that came out of nowhere that could turn the market more bullish. But there are times where you can, not exactly, but pretty much know what's going to happen next. But the market does a lot of things. You can't know it all the time. You can't know every day what it's going to do. And if you remember last month, there were some of those updates where I was really frustrated because there weren't any clues. There weren't any strong clues, at least, that were pointing to a particular direction. And but there again, that's, if you can learn to recognize when the clues aren't there, that's when you don't want to be trading. You don't want to be doing anything. Just wait until those conditions get in your favor. So what we were looking at on Tuesday was we had broken out. We keep pointing out this as being a very important area. We had broken out above there. We dropped back below there, and we tried to rally. And then on Tuesday, we opened down a little bit, and we rallied right up to that key resistance area right there. And then we came all the way down, and we were going to close not only near the lows of the day, but we're going to close below the low of the previous day, which is typically a bearish confirmation there. There's a very high probability that the market was going to drop. Now, what I wanted to see, though, the next day is I wanted to see an attempt to rally again, or at least to open near where we closed, because usually the best selling, usually it happens when traders initially think that things are going to bounce back up. They're buying the dip right there, thinking it's going to come back up, and then it doesn't, and then they get crushed and they really sell and they panic. It's similar to what happened on Tuesday, where again they bought that initial dip down, it rallied up to that resistance area. And again, if for those that are new, there was a big reversal on January the 10th, the bullish reversal. Then it rallied up to it on February the 2nd, February the 9th, and it failed. And so that's why that's significant. But so they bought the dip, it rallied up to that area there, and then it slid. And as it slid back down, that fuels the more selling, and it fuels a little bit of the panic. I was hoping for another attempted rally. When you get a big gap down like this, now you have to worry about flushing out that maybe that flushed out all the sellers. That now maybe you rally off of that and it comes back up. Because also what I talked about on Tuesday, and again, you can review that class, that recording if you missed it and you want to get the more details of this. But with this type of setup, we have that initial move down and you try to rally. Either this is wave A, that attempted rally is wave B, and you're about to get wave C, excuse me, or based on Elliott wave, you got a much bigger move down. This is wave 1, wave 2, and you're going to get wave 3, wave 4, wave 5, or something like that. Okay. Now, sorry, to get the allergies this time of year, and I feel like I'm congested. So I'm congested in the wintertime from normal colds and viruses that go around in the winter, and I'm congested all summer from all the pollens in the air. Can't win. All right. So, and what I talked about on Tuesday, I'm pretty sure I mentioned this, but I probably pointed out this as being around here as being an area that we might drop to if this was a wave C. And why did I do that? Well, typically wave A and wave C are about the same length. So if wave A is this length right here, wave C would be about that same length. And then I looked over here at this resistance. There's a little bit of resistance here. So I said, this is probably an area where we would pull back to. And so it's not surprising that that's where we gap down, and that's where we've been kind of sitting, is down near this area right here. Now, before you go run out and say, okay, well, that's an ABC pattern then, and we're gonna go higher from here. We just don't know that yet. I mean, it's possible it finds a little bit of support there and starts to rally back up. But yesterday was an indecision day. That's an indecision candle. We opened right up here. We traded up to this point. We traded down to this point, and we closed just a little bit lower than where we opened. The buyers aren't sure it was going to go up. Sellers aren't sure it's going to go lower. And we look at today. We got the same thing going on today. So there's a tug of war going on, and we don't know who's going to win that tug of war yet. This could still be wave one, wave two, and this battle could be over, and we slide down into here for wave 3, 4, 5. We can get that bigger drop. But even if we do get a rally, I still think that rally would be short-lived, and we're still going to end up with more downside. I really wouldn't be buying that rally. And here's why. And this is part of the argument I made on Tuesday. I don't want to go through the whole details of that, but one of the things I pointed out was the last Friday's move of the chip stocks and the Russell 2000, or no, not the Russell, the Dow Transportation Index. So the SMH is the chip stocks. They tend to be a leading indicator of the tech sector. So the QQQ, they had this big slide right through here where the QQQ was actually holding up and going a little bit higher. Now we're all the way down here. We're very close to. This is a key reversal day right here. Now the Qs actually went lower than that, but this is a key reversal in the S&P and the Dow and all that. The chip stocks are already down to that point. It's even more glaring when we look at the transportation index. So let's look at the IYT. Here was that key reversal day. We've broken through it. Now we are off the lows of the day, okay, but we've broken to a lower low right there. Now, if I keep talking about the transports and the chip stocks as being leading indicators, they tend to lead in this case, leading the Dow Industrials. Okay, well then let's see where the Dow Industrials are in comparison to the transports. So let's pull up the DIA here. Here's that key reversal day. We're nowhere near it. Well, I shouldn't say we're nowhere near it, but we're pretty far away from it. So either the transport move is, we just got to ignore it and say, just forget about it. It's just, we're not going to pay attention to that. Or you're going to say, hey, that is a major warning sign. And I don't want to trust any rally that this makes, because any rally just means it's just going to prolong the inevitable, which is we should end up down here at some point, maybe even lower at some point. So, yeah, I think that's an important factor to just tuck away there, because we've been sitting on cash, a lot of cash for a while now. And again, I'm not saying there aren't trading opportunities. I am going to go over some stocks today, and stocks that should hold up pretty well if we sell off and go up if the market goes up. But I would be very cautious with that signal that we're not seeing. We're seeing from the chip stocks, we're seeing from the transports that there's likely to be more downside. And then you bring in the fact, just common sense, where you say, okay, I talked about this on Tuesday as well, don't fight the Fed. Well, that usually means that when the Fed's lowering interest rate, you want to buy because it means the market's going to go up because all this money's coming into the economy. It's got to go somewhere, and it usually ends up in the stock market. Almost always ends up in the stock market in some way or fashion. Well, when they're tightening, and not only are they tightening, they're screaming that they're tight. They are all the talk right now is that they are slamming on the brakes of the economy. There's talk that they need that they're going to need to push the economy into a recession to get rid of the inflation problem. How can that be bullish for stocks? And then you say, okay, let's look at how far have we corrected? Here's this big run up we've had since the COVID low. The COVID low was down around here. Here's this big run up, and that's all we pulled back from, and we've got all these problems coming up. Typically, stocks will retrace about 50% of their moves. You're going to move up like this. They'll typically come back about halfway. Again, that's usually the rule of thumb. They don't have to be exactly 50% retracements. But this is nowhere near a 50% retrace. This is probably a 50% or closer to 50%, maybe right up into here. That's definitely below this reversal area right here, right, that we were looking at. By the way, what do I keep talking about as far as forming a strong bottom? You want to, in order to form a really viable bottom, you want panic, you want fear, you want panic selling to take place. We never got that right. We got close. We never got that right here. With everyone thinking that it's over and it's going to move up, and that's all you've heard about on this rally back up was, okay, the bear market's over. The worst is behind us. I don't know of a better environment to create fear than if we roll over and suddenly have a panic sell-off or start dropping. That's going to cause panic selling, and that will push us lower there. And boy, I tell you, if that happens and we get down, into these areas here, we get some sort of bullish reversal day down in here somewhere, I'm going to be saying buy. That's when you want to buy. That's when you want to put the majority of your capital in, because even if it does go a little bit lower, it's not likely to go that much lower at that point. And then you have that tremendous upside potential. And I will tell you that if you're waiting for a recession for the market to bottom, the market will bottom before a recession hits. And so it's always forward looking. So, but and so what's going to happen likely is we're going to be buying when everyone else is panicking, and we're probably going to be panicking too. It's going to be hard to buy because we're going to be like, boy, it just feels like it's going to get worse, and how much worse is it going to get? I guarantee you it's going to feel like you don't want to buy and you're scared to buy. And that's the environment that that's when you need to start considering buying is in that, and you'll be looking around and you'll probably see a market slow down. You might see unemployment rising and all these other factors, and the worst of the recession wouldn't have hit yet, and the market will start rising, and then that's the cycle. That's typically what happens. Now the specifics of that, well, you'll have to stay tuned. We'll have to look at it week to week. And there's going to be, within that, there's going to be weeks where I'm saying it's bullish and for the next week or two, and we should rally for the next week or two. And I'll flip flop back and forth in the near term, but that's kind of a general picture there of how things should play out. Now the market doesn't always do what I think it should do. Now, I did. There is a good question here. Are there bearish trades? Well, with this software is a trend-following software, and it's meant to be an investing software, which means you're typically, although there are some features of the software that where you can short stocks, and things like that. I don't like shorting stocks. It's too risky to me. It's too much. Well, it's unlimited risk if it goes against you in a huge way, because if the stocks can go up forever, versus there's limited downside reward. They can't go below zero. And then there's all other aspects of you have to borrow the shares and all that kind of stuff. But there are inverse ETFs. I did mention some of these on Tuesday, and I want to show you another one I got into right at the end of the day. I told you I was going to get into that SARK ETF, which is kind of opposite of what Kathy Wood is doing with her ARK Innovation Fund. That's done really well. That trades it well. But I'll show you a couple of inverse ETFs that you can trade if you expect the market to drop, and that's why the portfolio's up in a pretty decent way the last couple of days, is because of those two trades on those inverse ETFs. But I'll cover those here in just a second. So, bottom line, near term, we could rally off of these. We could rally off of this a little bit, and possibly maybe even go a little bit higher. We might even come above this high right here, but I think there's still that big risk of one more bigger move down. I think it's coming, and I'll keep watching for those signals, those candlestick formations, and that price action to see if we can't see when some of these moves are about to hit. Let me go down through the list here. Another area of concern was the Russell 2000. That tends to be more of a leading indicator as well of the other indexes. It tells you when there's a risk on. It's sliding, and it's trading below this key resistance level. This was that 2-year. It stayed above this stayed in that sideways range for 2 years, or for a year, for most of last year. Broke through it, and it hasn't been able to really get above it. And in fact, it could start working its way to new lows. There's that key reversal day again. That's one you want to pay attention to. Let me go back to the S&P chart, because if you're new, you got to pay attention to these areas in a big way. They're going to tell you. Okay, so we have that January 10th reversal day, and that's followed by the February 2nd, February 9th, where it failed to break back above there. You can even kind of point out this area right here where it broke out above it, came right back down above it, rallied up to it again on these 2 days. This was a big reversal day, and that was the the February 24th reversal. What happened here is we were selling off. Then we had a panic open. It dropped all the way down here. But see, this is why I don't like gap downs, because they can reverse on you. That's what happened. It gapped all the way down here. The fear spiked a little bit, but not enough. And typically, when I talk about that big fear hitting, it's usually over a few days. It's not just a one-day event, which is what happened here. It's just there's a quick little spike, and then it rallied up to here. So this low is going to be important. It's going to be very important, because there were some buyers that came in right in this area right here. Because if you remember that day, we opened right here, but within seconds we were all the way up here. So those buyers came in immediately before anyone else could come in. So they had to be professionals, or probably those computer trading that's lightning fast, faster than we can trade. But they were in right in this area right here. And the reason why I say it's this area right here, why not higher than that? Well, because again, we opened and then we were right to this point, and then look what happened. We came back down, and immediately when we got to that area again, it popped again. Got back to this area again, it popped again. So this area right here is significant. And if we drop below that, that is when you should see kind of all hell break loose, or the panic really kick in, because whoever these guys were, they were big enough to push the market up for a couple days, and if they get eliminated, because no one else was willing to buy down here at that time. If they get taken out, you got to wonder who else is going to buy. There could be another big money player that jumps in again there, but anyway, that's a key reversal area to pay attention to. And by the way, this one is important as well, because if we do get back up here, if we do rally back up here, do we break back above there? And if so, that would be bullish. But if it comes back down below it again, that would be very bearish, and that could mark a start of a bigger slide if it were to do that again, break out above it, come back below it. So this is something you really need to pay attention to. Either above it or below it is a key area there. And I know some of you are going to say, well, why? What's so significant about that? It doesn't matter. When you're a technical trader, you can't be focused on the whys. You're focused on what is reality, what is happening. If a stock is going up, I don't need to know why it's going up. In fact, I don't really want to know why it's going up. But sometimes that gets in the way of my analysis or my objectivity, because you could say, well, boy, that stock's going up, and they just had some news that that their earnings are increasing. And so what do you think? You think, oh, well, okay, that's the reason why it's going to go up, and so that's good. That's really good. That means it's got to go up, right? Well, what if it flashes a bearish reversal the next day? Well, then you're gonna say, well, wait, that doesn't make sense because their earnings were good. Okay, I'm going to ignore that bearish reversal because it's going to go up because their earnings were good, right? I can't be thinking that way. I can't be trading what the stock is actually doing at one time, and then trading fundamentals or news or at the other time, because they're going to conflict. And if they do conflict, where am I going to lean on? And if you're going back and forth on what you're leaning on, you're going to be an erratic trader. It's not going to work out very well. On the other hand, what if the stock's moving up and trending up, and he's heard that there's news that there's some accounting irregularities or something like that, and that's bearish, and you're like, well, wait a second, why is the stock going up? Then you might not trust the move because you're thinking, why it can't be going up, And I do this sometimes. I'm not saying I'm not perfect, because you'll hear me. I'll throw out some of these reasons, but the bottom line is you don't want to be focused so much on the reasons that you ignore what is actually happening. All I really care about is that stock is looking like it's going up. I did a trade a couple weeks ago, a few months ago, I think, and a trade recommendation I was going over, and I had someone say, well, I wouldn't trade that because there's some fundamental reason. I can't remember what the reason was, and I'm like, okay, that's fine. But in this case, in the particular situation, I was only going to be in the trade for about 2 or 3 days. This is not an investment. This is just a quick trade. And so my response was, what in the world is going to change fundamentally in 2 days about that stock? The bottom line is that stock looks like it has a high probability of going up over the next 2 days. I'm taking advantage of it. So I don't want to get too caught up. Now, in investing and with some of these longer term trades, you can factor some of that stuff in if you want, but this is a trend following software. So you really want to focus on reading trends, and as opposed to the bottom line is you're letting the big institutional traders do all that analysis for you. And if they like the stock, they're going to be buying it because they're the ones that can make the stock go up. They can do the heavy buying that causes the stock to go up. You could outguess all these professionals, and it doesn't matter because you buy your 100 shares and the stock's not going to move because your 100 shares isn't big enough to move the stock. So what I did early on is flip that around and say, okay, I'm not going to care about outguessing the professionals. Let's just get good at seeing what they're doing. Let them decide if that stock's a good stock, and it'll show up because it'll start trending up. They'll start buying and it'll start trending up. Or if they're selling, it'll start trending down. All right. I'm going to quickly go through the rest of this list because we want to get to have some. Well, we want to look at the portfolio, and then I want to get into some trades, which is the whole purpose of the class. Bonds. Now they made another move lower. We were expecting that. We had this little attempted rally, and now they're getting a little oversold again. They probably due to bounce. They're in that extreme reversal risk there. I would say this high now becomes, if it can break above that could signal potential trend reversal. Other than that, any rally we're assuming any rally before that we're just assuming it's going to continue to move lower. Because that's the trend right now. It's definitely trending down. Bonds are trending down. Gold still in that indecisive area right there. Oil is kind of the same. Could go either way in the near term. The dollar did break out and go higher here. We were anticipating that on Tuesday. The VIX. So we do want to pay attention to the VIX. We did spike a little bit. On Tuesday when we were talking, we did have another move higher. Now this isn't look the exact same as the VIX indicator because it's the ETF that allows you to trade the VIX. That's it has to be it has to be a tradable instrument to be on Traders Pro, but we use it as a proxy. But it's the key, if you are looking at a VIX indicator, is 30 would be considered, and these numbers don't line up because it's a different. I don't know how to explain it. It's a different trading instrument, but 30 on a VIX is considered extreme, or there's fear in the market at that point. We're not there yet, but what was significant on the VIX indicator is over the last. Well, with the intraday high from yesterday, we were actually halfway from this drop to that 30. So let's say this is 30 up here, and this is about 20 down here. In that 2-day move, we got about halfway back to that 30 area. So that's significant in the fact that there is a little bit of fear building. And now it's dissipated a little bit today with the indecision, but that's something to keep an eye on. We looked at the chip stocks and the transports. Transport's really still collapsing here. Bitcoin pulling back a little bit, still holding up okay. All right, let's go to the portfolio. So I did tell you I was probably going to get out of net, and I did. And I did get out of that on Tuesday. Net, again, this is the way it looked on Tuesday. I looked at this as being possibly being wave A, wave B, and this was either going to be wave C or wave 3 or whatever. It did drop, but this is one that we're going to look at today and put it it's going to be in the watch list, because if it does hold up and we do start rallying back up, this is still looking overall pretty bullish. The fact that we broke out above here, if we had pulled back and then have a higher low through here, I'd want to get back into this. So I don't want to just, and that's why I might jump in and out sometimes. There was such a high probability we're going to get this drop. I'm thinking to myself, why take that loss when I can get back in? Now I get it. There are tax implications, and I should probably throw this out. There's a disclaimer before any class I do that I don't factor in the tax implications, just because I found early on that I made a lot of bad decisions and took big losses because I was worried about the tax implications. If you're paying a lot of taxes on things, it's probably a good thing. It means you're making money. So I don't know. That's kind of the viewpoint that I took. Now, that's me. I'm not going to force down anyone else, but I don't mind jumping in and out of things. And especially in this case where I knew it was probably going to drop, and that I could always get back in. All right. Now, OAS is the oil stock, and I'm close to my stop. I have a tight stop on this one. It's right here, but it's still holding up. Now with this drop right here and this attempted rally right here, it's acting like it probably wants another move down. So I'll probably end up, probably a good chance I get stopped out of that within the next couple of days. But we'll see. If the market stages a big rally or so, it might hold up. Our defense stocks are doing great though. There's Northrop Grumman, NOC. Let me switch these over to signals here. Gone back to a buy signal there. Lockheed Martin. And now notice on these, and this is what I had talked about on Tuesday, was that they weren't dropping. The market was looking really bearish, and they weren't dropping really at all. They were holding up pretty good, and so that's always a sign that if you've got stocks that aren't dropping when the market's dropping, especially if you think now in this case I think there's further to drop, which if that happens when the fear kicks in, everything starts dropping. It doesn't matter how good the company is fundamentally, everyone just starts selling, and that's when it's a kind of a panic sell. Is it just when you see Apple collapsing, that's another one to keep an eye on, because if it starts just really dropping with the market, that it's a pretty bad sell-off. But these have been holding up pretty good. And then here's SARK. This was the opposite of the Cathie Wood ETF and the ARK Innovation. And so again, this is an inverse. I'm going to switch this over to. And by the way, with this type of a trade, you're going to ignore the signals, because you're not trading it for the signals. You're trading it to have something that goes up when the market goes down. Have an opposite type trade that can help you profit when the market goes down. So if you're waiting for this to go to a buy signal to get in, that sell-offs happen so fast. They tend to. You could have a rally, and this happens all the time. Well, look at this right here. So here was a rally that lasted, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. And in basically 4 days, it wiped it all out. Stocks tend to fall a lot faster than they rise. Here you had 1, 2, 3, 4, 5, 6, 7, 8-day rally, or 7-day rally, and then 2 days it wiped it out. So if you're waiting for that to go to a buy signal, the sell-off could be over, and by the time it goes back to that buy signal. So that was the reason for buying it. It was just that I knew that if those stocks in that fund were to drop, which they likely were because they're riskier trades, this should go up. And now there are also, you could just trade the opposite. I have this inverse ETF thing right here. You could just trade the opposite of the S&P 500 index, SH. I pointed that out on Tuesday as well. But the problem, what I don't like about it is that this doesn't move enough. If we got a big drop in the market, and this went from 14 to 15, look at that. You have to make that big of a move just to go up $1. Okay, let's look at SARK. So I got in on this day right here. It went from 43 to 49. It was that's a $6 move right there, and that was barely a move. If it got all the way up here, like on that other one, you're talking about a $10 or $15 move, or $10 or $13 move. So this is just purely defensive. But key here is and I'm going to be watching this too. If the market looks like, if that does end up being a bullish ABC pattern on the S&P, and it looks like we're going to rally, I'm going to have to get out of these, because it could just give it right back again if it drops. And luckily the other stocks went up too, so it's not like I was losing money on the aerospace stocks and making money on this, and it just washed. We actually had both of them go up, which is why the portfolio increased. But another one is this SOX. SOXS, which is the opposite of the semiconductor index. So again, if you see a situation where chip stocks look like they're going to drop, and again, if chip stocks drop, the SMH, it means that the market is likely to drop, and you want to hedge a little bit. You want to see if you can make a little bit of money if the market does drop. You can use this opposite ETF, and you can see this is what's kind of troubling, is that this is actually looking kind of bullish, a little bit of a double bottom right there. If that's bullish, it means bearish for chip stocks. So, but there again, I got in this one about 38, and this made even a bigger move. It got up to about 48 with the intraday high today. So these have a bigger potential for bigger moves than just trading SH or those other inverse ETFs or the regular market. So anyway, these are a couple. There's more of them out there. I probably need to do, because some of them you have to be careful on. They're not very liquid, and so I'll try to build a better list. I need to go out there and build a nice list I could give you that you could kind of keep track of. Make your own little watch list there. So yeah, those are all. We're up to 105 now. 105. We're down to around 102 or something on Tuesday. Not much. So we made about 3,000. A lot of that though was from the SARK and SOX trades. All right, let's get into some individual stocks here. Oh, question: how to identify the big traders? I don't know who they are. I don't care who they are. If they're big enough if they're moving the market, they're big enough. They're big because they're moving the market. So I don't need to know who they are. In most cases, you can't know who they are, because they're not going to be like, hey, I'm Joe, famous trader Joe, and I'm gonna buy Costco today, and hopefully you don't buy it before I do, because you're gonna push the price up even higher and cause me to have to buy it at a higher price. So they're not gonna identify themselves. But if it's the market's moving, it's the big institutional traders, those big money players that are moving it. You can't move it with your 100 shares that you buy. So yeah, you don't. I don't know who they are. Oh, well, I mean, you can know. Warren Buffett is big enough to move the market. There are some of these big fund managers you see on TV that are big enough to cause the market to move. But yeah, I don't need to know who they are. Just that's they're causing the market to move, and then I want to follow. Question: getting out of trades I struggle with. Let the winners run. Yeah, a lot of that has to do with. Now again, I've talked about this a little bit. I tell you where I address it a lot more in detail. If you go into Traders, go to Traders Pro, go to YouTube and go to the Traders Pro channel on YouTube. And I think you have to subscribe. It doesn't cost you anything to subscribe, but you just subscribe to it. And there's a training I do on trade management. There's several of them. One way you do it is a trailing stop. And we haven't had a big enough run on some of these for me to show you how I use a trailing stop method. And that's the thing, is we've been in this depressed market moving down for several months now. When it turns back into more of a bull market, what will happen is you'll get into, well, let's take one of these stocks here. So let's say I got into Lockheed Martin, and I can't spend too much time on this because I want to get to some stocks. But let's say I got into Lockheed Martin down here. I got in, maybe it broke out right here, and then I put my stop initially down here. Okay, this is where I know I'm wrong. This is where I'm going to get out. If I don't get down to that point, then you stay in it. You've decided, your plan is that's where I'm going to get out. Okay, and so you've got to identify how you're going to manage that position. So here it pulls back. You're not panicking because it's not down there yet, but it forms another low right here, and it starts to break out again. Okay, now I can move my stop right below that low, because now it's acting like an uptrend. That's a higher low. It went to a higher high. There's a higher low. Here's where I would know I was wrong, because if it's something reversed and went to a lower low, that's what a downtrend does. So it runs, it runs, it runs. It's not down there yet. Runs. Here has another pullback. You're not panicking because you're really having some nice profits now. And then it breaks out and goes higher again. Okay, now move that stop right below that low. That's your next higher low right there. Went to a higher high. Here it kind of just moved sideways right through here, and so then it broke out right through here. Okay, then let's move our stop down below that low. Here it really made a nice big run. Pulls back. Starts to move up again. You can move that stop right up into there. I can move that stop right up into here. You don't have to, or you can keep it back a little bit further if you're afraid it could get bounced out. But that's one technique. And then if it finally drops down there, okay, there you get out. Some people use a moving average. If it drops below the 150-day moving average or something, you can't use moving averages here on this software, but those are techniques you can use. But I go over a few. You could get out when it goes to a sell signal. That's what the signal system is for. Let it run until it goes back down to a sell signal. Sometimes it'll go. This is what I'm saying. The software is designed to simplify the process. Okay, get in on the buy signal. I'm going to get out on the sell signal. The problem is, by the time it gets to a sell signal, you might give back a ton of the gains, especially the last gains you've made. It might have to come all the way down to here before it goes to a sell signal. If you know other techniques, which is what I teach you in those trainings, then you can develop other techniques, and you can merge techniques. You could say, one thing is I'll do a trailing stop, and then when it goes on a run like this, I know it's probably going to come right back down. I could say, okay, it's really getting overbought. I'm going to get out when it closes below the low of the previous day, because that would tell me, that'd be a first signal that this thing could be pulling back. Well, when did it end up closing below the low of the previous day? Right here. Okay, I got out, and then you could always get back in again if it starts taking off again. Anyway, those are a few techniques that can help with that. But the biggest thing is having a trading plan. How are you going to manage the trade? How are you going to recognize when you need to get out? And that's a lot of that is what I taught in those trainings, and what I try to teach in these live classes. All right. And part of my problem is that I know how to read short-term price action. So, like technically on net, I shouldn't have gotten out of that. Okay, I should just let it run, let it go until it reached my stop. But I knew there's a very high probability it's going to drop the next day. It's hard for me to take that loss. But that's why I did those trainings, is because I could teach you the right way to do it, and then at least when you're starting out, and then I can teach you in these live classes the curse of being able to read price action sometimes, where you can tend to jump in and out of things like I tend to do sometimes. But by the way, I will fix that a little bit. Part of the problem is that when I started the portfolio back in July, we started to move up. We started to make profits, and then we had the pullback through the end of the year. We had that pullback happen, and so the portfolio dropped down to 80,000, and so I've been just trying to make sure I've been doing a lot of things in the last month to 2 months to get this thing back positive again. And we're in an ideal spot because now the market's pulled back, and it could pull back even further. And when it does, we're going to get some nice runs, and then I'm really going to be able to teach staying in your trades, letting the profits run, letting things go. It's hard for me to let things run when you're in more of a bear market condition, when I don't think the market's going to run for several months. We're getting close to a bottom though, where I think that we'll be able to do that, and I'll be able to teach you some really good things in some future classes on how to let profits run, and we'll be able to see it. We'll be able to see it happen live in the portfolio. What I've been able to teach you over the last few months is not being afraid to have a lot of cash, not be afraid to stay out of the market, and not have your profits your account just get eaten away on these pullbacks, because you want to have that cash when you're at that bottom. All right, I got to get into trades here. All right, so out of the watch list, I'm going to start there because we've got some good ones right in the watch list. Okay, what's happening here? Hold on. I just had to jump back in the site. It kind of froze up on me there. All right, so let's go to the watch list, stock specific class. You know what's starting to look interesting is some of the oil stocks are pulling back a little bit. So this is FIX. This one, we could still have potential trade there. I don't see anything right now I want to get into. MTDR is an oil stock. It's been kind of just consolidating a little bit, but I like, U.S. oil is pulling back. It can go back to a buy signal. That'd be one you probably want to have some exposure to. Oil, I think, is just still going on. Marathon looks like it's possibly in kind of a wave C, wave A, wave B, wave C. And if it goes back to a buy signal, it'll probably break out again, or it'll start to break out again. That's one that, again, I'm not saying jump into these right now. I'm saying these are ones you want to keep an eye on because they have pulled back and they've been in strong uptrends. So if the market does rebound, if market rebounds, I think you want to be in oil. You want to be, what's been working the last month and 2 months? So oil, aerospace, the defense stocks, we've talked a lot about those. Those are ones you want to be in. Alcoa right here, I like this. Possible ABC pullback after breaking out, broke out, pulled back a little bit, and go back to a buy signal, and especially if we can get back above that breakout area. Now, if the market sells off, these could have deeper pullbacks, but that's why you're keeping an eye on them. These are ones you're watching and seeing if the market rebounds and they start to rebound. Again, all these defensive stocks are going back to buy signals. They still look pretty good. There's a couple here for new entries right here. General Dynamics just went to a buy signal today. I like that consolidation through here. It's close to breaking out. And then Raytheon pulled back a little bit deeper here, and then had a nice bullish candle today. That looks like a nice one right there. Raytheon is the one that makes all those Stinger missiles and the Patriot missiles and stuff that we're planning on sending Ukraine. I don't know if doesn't matter. Doesn't matter what the fundamental reason could be. See, I do it as much as I say don't do it, or it's not a good idea to do it, I'll do it. But a lot of it too is that I'm teaching a class, and sometimes it's people like to hear that. I like to hear it sometimes too. I mean, just reasons. That's human nature. We want to know reasons, but we don't have to know the reasons. Just what the chart is showing us. All right, so those ones I like. Let's go down the list here. Net. Again, I got out of this one on the drop, but if it can hold right here and come back up again, especially to get back above that breakout area, I'll probably be right back in that one. So those are from the watch list. Well, an entry for like Alcoa, usually the for this class, what we talk about is waiting for it to go from hold to buy. So you're waiting for the buy signal as confirmation to get in, but like I said, there's different entry techniques you could use. You could wait for it to break out above here. So if you wanted to put an entry price above that area, so if it gets above that, because if it gets above that area, it's probably going back to a buy signal too. You probably get both. But you could put a price order in somewhere in that area right there. But to keep things simple, usually we're waiting for it to go from hold to buy. So one thing you can do is, now this is already in the watch list. So let's go to the watch list, and then I can actually, some of you are aware of this, but you can put in an alert. So here's Alcoa. Hold on, here's Alcoa right here. You can put an alert right here, check that box, and you can set up an email alert to tell you when it goes from hold to buy. It'll send you an email. And then you can just wait till you get the email. All right, let's go to sectors here. I'm going to go down the list a little bit. Under business services down here, under the holds, I like the top one up there, Avis. CAR is the ticker symbol, 99 strength rank. So nice high strength rank. I like that it's pulled back. I also like it looks kind of like this bowl-shaped move. This is like a little bit like a cup with handle formation, which is a nice trading formation. Again, just wait for that to go back to a buy signal, or you could wait for it to break out above that consolidation area right there. So we can add that to the watch list. Another one under business services. The next one, HSON, Hudson Global, 96 strength rank. And it's been a nice uptrend, a little sharp sell up right here. And it could be that's just wave A, you get wave B and wave C, but I do like it's pulled back to a trend line right here. Those low, that low, close to these lows too, but there's a little bit of a trend line right there. It's pulled back to. Have to kind of see how that looks. That might have a lot to do with how the market looks. If the market looks like it could rebound strongly, and that might be a good one. And then another one in that sector is DLHC, 94 strength rank. Now, again, this would need confirmation. They need to come back up again, but I like the bowl. Whenever you see the bowl-shaped move, and the problem a little bit right now is it's broken. Here's where it broke out of that bowl. It was having lower highs, lower lows through here. Had an even high, even lows, broke out above it, now we're back below it here on this pullback. But if it can hold and start to move back up, you've got another higher low. But it would probably need to move back up and get back above this resistance right here. That I'd like to see that. But again, that's why we're putting in the watch list. We're not saying it's ready right now, but and that's really all I want to do today. I don't want to really get into anything today because the market still could have that bigger move down. So all these I'm waiting for confirmation on anyway, and that's what I want. I want to just build a list. I'm just building a list in case we bottom. I want to have stuff I can go. I want to go to that watch list and be able to say, okay, is there something I can get into now? You want to be prepared for that. You don't want to be starting your search at that point. You want to be going right to that watch list. You feel like the market's bottomed. All right, under the defense sector, which is aerospace. I like this one, TGI, Triumph Group, 89 strength rank, but these, again, from a relative standpoint, tend to have a little bit lower strength ranks. If you look at all those, Raytheon and all those, they were in the 80s. That's okay because they don't have too many 90 strength ranks. The 80s would be still a good strength rank for those. But TGI, again, could be, this looks like a possible bullish ABC pattern right here. Again, I'd want it to go back to the buy signal and make sure that's a higher low, or that's put in a higher low. It did have the higher high. I'd want confirmation maybe to get back above that breakout area again. That's probably when you get the buy signal anyway, but that's one I'd keep an eye on. And then I went down into the medical sector. One of the reasons for this is I was looking at, I have a watch list where I have the Dow stock, the Dow 30, the 30 Dow stocks. It's a quick list I can go through if I'm looking for large companies that look like they have nice tradable patterns. But United Healthcare, we'll look at United Healthcare. So the market's been selling off. Look at United Healthcare. It's been moving up nicely. Big move last couple of days. Pfizer is a Dow stock. Nice big move over the last couple of days. By the way, that looks like it's coming out of looks like a bullish ABC pattern. Well, this is a bullish ABC pattern. How to move up, bullish ABC pattern. Looks like it's taken off. By the way, Pfizer is one that is in the list that I'd be considering, and it did go to a buy signal today. But Merck's another one that's been trending. So I noticed these medical stocks have been going opposite of the market. Market's been dropping. These have been holding up and actually doing really well. So I went down into the medical sector down here. It's down lower on the list, and found a lot of good ones. Now, some of the more famous ones that I said, Pfizer is there with a 92 strength rank. Molina Healthcare, MOH. Let's take a look at that one here. Look at that. That's a nice possible bullish ABC pattern right there. I'm back to a buy signal, right? It pulled back to a breakout area, so it broke out, consolidated, and that thing could start taking off. That's a good. And a quick way to manage it, you could buy on the buy signal and put a stop down below here. You know what? I'm gonna go ahead and add this one to portfolio. So I'm going to put the stop because it'll give me a little bit of balance in there, and it looks like it's doing pretty well. I'm going to put my stop down below here, so about 324. I'll just say 324, below that low. So you go to this blue button over here if you want to add it to the portfolio. $324, stop. 50 shares is too much. 20 shares. Try to keep the amount around 8 to 10,000. So I'm looking right here. This will be about 8,500 in the trade to buy those 25 shares. And then I'm looking also. Hold on. I'm also looking down here. I don't want to have more than 1.5% of my portfolio at risk. Which, if I'm putting $10,000 in the trade, I don't want to lose more than $1,500 if I'm wrong. In this case, it's even lower. It's only at 0.4 or about $425 I'm looking to lose if I'm wrong. So those are pretty low. I'm going to go ahead and add that in. Question, airlines are all in the strength rank of 60. Would you never buy them? No, I mean, again, as you go through these lists, you'll start to see there's a relative nature to some of them. For instance, construction stocks, for instance, you never get a 90s. You occasionally will, but you almost are always in the 80s or even the 70s. So you can drop down in the 60s or 70s on some of these if that's just their relative nature. It probably does mean you don't want to be overweight in airlines by any means, but you could get into some airlines as a diversification. A lot of it will depend on, so as you're looking in those lists, you'll be able to tell, because the highest, let's say the highest stock under the holds is a 70 strength rank. Well, then that probably is a group that doesn't have high strength ranks. Or maybe just as a whole, the sector's been beaten up. And if that's the case, you want to stay away from it because the whole sector is down and a little bit too low. The bottom line is you want to stay with high strength rank, high performing sectors and stocks as much as possible. But if you do, the one thing you have to be aware of is that if you're not careful, you can have everything in those sectors. Like I'm very overweight. Was overweight in oil, and now I'm overweight in aerospace. If any of those industries take a massive hit, I'm going to get hammered. So you do want to diversify a little bit, and we will. When we're in a healthier market, we'll have a much better diversification because we'll be picking strong stocks within a bunch of different sectors that are good and strong sectors. And but these are just the ones that are moving right now, so, or they're good, look pretty strong right now. All right, I got to hurry here. We're way over time, but let's go with BeyondTech right here is another BNTX 92 strength rank. But this is these are more well-known ones, so I want to start with these ones because most of you are probably familiar with these. Again, it's had a big pullback, but it looks like it could be turning the corner. Lower low right there. It has a slightly higher high, but you'd like to see it really clear that area right there, and that would give you a higher low. You could even call this a little bit of a potential inverse head and shoulders pattern, but a lot of it depends on getting above here. And you definitely have a buy signal if it got above there, but then you have that huge upside potential versus very limited downside risk. So I love these types of patterns. But that's one to throw in the watch list. Let me throw it in the watch list here. Hold on. And then let's go up to this KZR Life Sciences 98 strength rank. That's what you'd like to be, is get a 98 strength rank. Again, I love the bowl-shaped move, broke out, came back in it. This looks a little bit choppy, like a corrective pullback. You can get back up above that breakout area and give you another higher low right there. That thing looks really good. Again, all these need confirmation, so or most of these do. HRMY, Harmony Biosciences, 95 strength rank. Now this could be wave A, this could be wave B, and it could have a wave C down. So I'd be very cautious about getting into this one because it probably has another move down, maybe down to this area to retest the breakout. If they can do that, I really would like that one. So that's why I put it in the watch list. I want to keep an eye on that one. And then last one, and I'll get out of here. This INVA, 94 strength rank. Again, it has this nice run up right here, kind of a V-shaped move, and it's kind of consolidating. Really, if this can break out, you'd really want to buy the breakout there. But if it can break out, give you a higher low right there, and then break out to new high, be good, a good entry point. All right, that's all I have. Real quickly here. I just want to see if the index is okay. So it's showing a pretty bullish candle right now going into the close. We'll see if that holds. Now it did that yesterday and then faded into the close and gave that indecision candle. So be careful. I wouldn't be buying heavily just on the way it looks right now. You'd want to see if it looks like it's going to hold that into the close. And again, if it does, it just probably means we could bounce a little bit. I think we probably need to fill in that gap, trade up to this gap. Here's the gap. So ideally, if I were to look at a bearish price action tomorrow, if we gapped up tomorrow and then ended up closing lower than where we opened, right in this gap area right here, that'd be really bearish. It probably means we're heading lower next week. Anyway, never does what I want it to do. All right. Thanks, everyone. Have a great week. We'll see you on Tuesday for the next market update. Bye now.